Okay, let's do a Q&A here. We'll start with the comments on Discord. I'd really appreciate your perspective on a line of thinking I've come across. Some investors suggest that part of the market rally might stem from a belief that Trump would be quick to reverse course on any policy that proves economically harmful and might actually intervene to support markets if conditions deteriorate. In that view, even if fundamentals worsen, there's an assumption that political will could override market signals, making it risky bet against equities. Do you think there's any merit to this idea? Well, that's the concept of the Trump put, is that he will be disciplined by the market. Yeah, I think there is something to that, but where is the put? Right? Is it 2% down? Is it 5% down? 10% down? 20% down? Where's the put? So while you say it might be difficult to bet against the market when the market is near all-time highs, I don't know that that put has a lot of value. If the market pulls back 3%, I don't see him putting in a put. Pulls back 5%, 7%. Last time it was basically 20% down that he put the put in. But you have a bond market that is causing grief right now. I think that is going to be the bigger issue. Higher yields are going to hurt the stock market. So there's not much you can do in the equity market for a put unless you cap yields. So yeah, I think there is something there. I just don't know how valid it is, and I don't know where the strike on that put is. Do you think it is still relevant for universities to be operating after this so-called structural shift in AI, GPT tools as GPTs become more capable of teaching or at least assisting students with their learning subject? Oh my God. If you use Gemini, within Gemini is something called Learn LM, designed by PhDs in education and in learning theory. It is wickedly powerful. So yeah, I think almost every professor and every teacher everywhere is going to have a subscription. You need the Gemini Pro to get the inclusion of this. Are going to have a subscription of this, and I think that school systems and universities will see over time that this is a superior system for designing learning material. Gemini will act as any professor's TA and will act as any student's personal tutor. So universities better change. They better change. Those who continually push back on AI, saying students should not use AI, are dinosaurs. They will disappear. How about the CFA program? Do you think it would still be relevant in as AI would be replacing part of a job positions and job market? I don't actually see that. Let me sort of give you a distribution here. I'll have more to say about this in the market outlook, but if we think about expertise as distributed normally in any population, so let's say we're talking about finance experts, because you're still going to need finance experts. Everybody in the field of finance, there are some people who have very low levels of expertise, very high levels of expertise, but generally we can expect an average level of expertise. It is this tail over here, the experts that are needed, because you still have to evaluate the output from a model, whether it be a learning model, a reasoning model. You still have to evaluate the output from that. These people using AI will replace these people. These ones here, I'd say about 30 to 50% of their job can be automated. So you will have job losses in here. So what will happen is the peak of this distribution will come down and you'll have a very skewed right tail distribution. Your job is to get into the right tail as fast as you can, and to make sure that your literacy, your digital literacy includes using all of these AI tools in all of their applications. But to say, well, because I have AI, I no longer have to develop expertise. would be a faulty statement. I would say that with the existence of AI, it becomes even more important to develop your expertise because you're always going to need a human in the loop. You'll always, these are just pattern matching things. LLMs are pattern matching things. Very efficient, very good, but still subject to hallucination. And when you have to make investment decisions on the output, you're going to want a set of human eyes, an expert that evaluates that output. Plus, you're going to need somebody to be able to prompt the LLM to produce the output. Well, if you don't know what to ask it, it's not going to know what to give you. And if you don't know what to ask it, saying, I want this, this, and this, but you know enough to say, however, do not do this. Do not do this, and I want you to analyze these things in this particular way. 1/2, 3/6, or however you want to do it. You still need an expert to input. You have the LLM, which is going to do the work that normally this tail or these people would do, and then you get the output, and you have to evaluate the output. It's much like somebody over here saying, okay, here's what I need. Well, give me an Excel spreadsheet with all this in there. It gives you the Excel spreadsheet, and then you look it over saying, yeah, that's good. You'll still have to do this, you'll still have to do this, but this will be done with the LLM. You won't need this anymore. It is even more critical that you get yourself into the right tail today. So no, I don't see the CFA program going away. I see the credential being extremely important, along with your digital literacy in using AI, such that you can now do the output that 3 or 4 could have done in the past. However, you still need to be an expert. I'm not an expert in biology. If I asked an LLM a question and it gave me something, I would simply have to accept it. I'm in no position to say, this is not quite right. I'm in no position to do that. So you would not hire me to be a medical doctor just because I know how to use AI, right? 2 questions on AI. In my firm, there's a small subsection of employees chosen from various teams to test AI and its use cases. My investments team is not allowed to participate since there's a lot of confidential data the firm doesn't want to use in AI models. That's the wrong way to think about it. You're not using your data in AI models. It's the same thing. Let's say you have a calculator and you say, oh, hang on, don't use that calculator to add up any numbers from within the corporation. We don't want our numbers being used in the calculator. You'd look at the person and say, but that's not what the calculator does. It's a tool processing input to give us output. It would be the same as saying, don't put any of our accounting information in the spreadsheet. We don't want to put our data into a spreadsheet. You're not actually putting your data into a model. The model is done. It's closed. No provider will allow you to put your data into their model because you could introduce bad data that would ruin their model. It's a tool, and you have data, and the tool is simply just processing the inputs into outputs. None of that becomes part of the model. None of it becomes part of the model. So if you're using ChatGPT or Gemini, you're using the API and you're asking it questions, that's fine. If you upload a document into Notebook LM, Notebook LM does not in any way incorporate that data into Gemini. It would be a security breach of the highest order, because ChatGPT would then begin to feed Notebook LM the most egregious data to ruin the model. No, it's just a tool. It's just a tool. This is implying the investment team is more protected from AI-related layoffs. No, your firm is more open to being obsoleted from another firm that is using AI and producing at a level that you can't compete with. That's what it means. When companies want to retain their otherwise skilled staff and train them on AI tools first as an organization, that's what they should do, yes. A few weeks ago, I asked about foreign currency risk. I said that if a Canadian investor converts CAD to US and immediately uses it to buy a gold ETF denominated in US, it would be perfectly equivalent to buying a gold ETF denominated in CAD. At the moment you do it, perhaps. You disagreed. This comes as a surprise, and I'd like you to dig deeper because I believe there's a misunderstanding. Taking a step back, let's say that you buy an ounce of physical gold. You can buy it using CAD or convert CAD to US and buy it for that amount. This would be perfectly equivalent. It has something like 1 ounce of gold, 100, 1 ounce of gold, 80 US. Exchange rate, two identities must hold, so there's no arbitrage. You're invoking an arbitrage argument. Textbooks. Let's understand something about textbooks. Textbooks have assumptions. They'll introduce a model, and they'll have assumptions. So this is a classic one in a textbook. Is ARB, is that gold in London and gold in Hong Kong. I don't know why those two countries are given, but those two places are given. They always seem to be that you can buy in London. And you can sell in Hong Kong if there's a mispricing until the two prices are equal together. And then it has assumptions. One is no market frictions. No market frictions. This is simply not true. And the other assumption here is that these are spot transactions, not financial transactions. If I buy a futures contract in London and I sell a futures contract in Hong Kong, since no currencies were involved, I can't possibly profit from anything unless the market adjusts it on its own. But let's say you find an ARB opportunity with the assumption in a perfect world, because textbooks have to present perfect worlds, right? Then yes, you have an arbitrage situation. You can engage in the physical transaction, right? Now, let's extend that out. If it works for gold, it must work for copper, must work for silver, must work for zinc, must work for iPads, must work for anything. That is called goods arbitrage, right? We're extending it out from the specific to the general, goods arbitrage. This is related to relative purchasing power parity, and we know that in the mid to long run, currencies tend to revert to the relative purchasing power parity level, but not in the short term, right? Well, what market frictions could there be? Well, there are transaction costs. Well, they're going to be small, but remember now we have to work in the spot market. Well, we have shipping costs. You got to get that gold from Canada to the US. So you got to take delivery of gold in Canada and you have to ship it to the US. Well, you're going to need some kind of security to get that done. You're going to need some kind of storage costs wherever it happens to be to get that done. And there's the US border. You get to the border, you say, I got gold over here. And they say, oh, hang on, there's duties, there's taxes. Oh, and by the way, there are these orange things called tariffs now. And suddenly it all breaks down. And you say, well, hang on a second. You take out your textbook and you point to a page. And the customs officer grabs your hand and drags your finger down the page to the assumption of no market frictions. And he looks at you and says, I am friction. Deal with it. That's the problem. Why do we do that in textbooks? Is because we have to present a situation saying, if, then. If this were the case, then this would happen. And we need assumptions such that this were true. We have to make this true. So we have 1, 2, 3 assumptions. We say, okay, well, with these assumptions, this would be true. So if we do not see this in the real world, it must be because of one of these things, and only those things. It helps us. We go to economics. It's full of models with assumptions. We go to finance. Those things are full of models with assumptions. We think about duration. Negative duration times change in yield plus the convexity adjustment. This is theoretical. I can't write while I talk. That is theoretical. It is not empirical. The real world doesn't work that way. We go through corporate finance, level 2, Modigliani and Miller. That does the capital structure of the firm affect valuation? And they come up with a theory saying, no, it doesn't. If these 7 things were true, then no, it wouldn't. But we know it does, so it must be because of the 7 things. So yes, there is this idea of arbitrage, and if you extend it from the specific gold arbitrage to the general goods arbitrage, we know that that is related to relative purchasing power parity that would tend currencies revert to their purchasing power parity level, their equilibrium in the long to medium term, but not in the short term. So I'm sure you can find arbitrage in the real world and say, look what I found. And I would then point to the assumptions and say, it must be because of one of these things. Look very carefully. So I know you're going, I can see that you're continuing on with your logic of arbitrage. And I get it. I get you're invoking the textbook argument of arbitrage. Whenever you invoke anything from a textbook, anything from a model, it's not the conclusions that are important. It's not the conditions that are important. It are the assumptions that are important, because the real world will not follow. So to know why, you must look at one of the assumptions. Now, if none of those assumptions held, if you said, no, but I can buy gold and I can sell it in New York, zero duty, zero taxes, and there's a company that'll ship it for free because it's gold, nothing going on, then you found arbitrage. If there are no frictions, but it'll be because of frictions. Best Buy earnings in 10 days, Dollar Tree earnings in June 4th. Look, I'm just going on what they're telling me. I am not fact-checking LSEG or sectorspider.com. I am pointing out what they're saying. And listen, they charge a lot of money for their subscriptions. And if they can't get this simple thing right, how can you trust the subscription price you pay for the data you get? How can you trust the data if they can't get this simple thing right? Yeah, you know what I'm saying. U.S. markets are not closed Monday. I'm in Canada. I got, and I use IB. IB was sending me notices during the week about upcoming holidays, and usually the Canadian holidays match the U.S. holidays. Labor Day, Christmas, New Year's, things like that. There's most of the holidays usually are the same. Sometimes there's only a U.S. holiday and no Canadian holidays, but I forgot that in May, Victoria Day doesn't necessarily match Memorial Day. Sometimes it does, but it doesn't necessarily match. I made the assumption the markets were closed. They're closed on Monday. U.S. markets will be closed on Monday. AI would likely to increase my output by 10x or 15x, but do you think using AI would likely make industry professionals and analysts eventually lazy and not intelligent, as they would not use their brain and brainstorming abilities less often and become almost completely dependent? Listen, for some of the repetitive stuff, right? For some repetitive stuff you don't need. Also, it's if you've seen the last video I put up using Costco with Notebook LM, it cannot do some things. You cannot rely on it. You still must be the expert yourself, but it is a good check on the logic you use to get somewhere. So maybe you read something and you have some thoughts about it. You can ask the LLM. You could say, what are your thoughts on this? I mean, obviously, your prompt would be a little bit better, but it is a check on your sanity. And it's also more for repetitive tasks that you would normally send to somebody else to get done. It's not meant to replace you. It's meant to augment you. So think of something you do on a repetitive basis, or some menial thing you do that you really don't want to do. That just, it's not high value added stuff. It's low value added. It's administrative stuff you got to do to get to where you want to be so that you could do the high value stuff. No, I don't think so. Because I understand I become seasoned finance professional, my competitive edge of being able to process massive amounts of information. No, don't worry about you being able to process the massive amounts of information. Focus more on being able to evaluate the output from something that will process the information for you. Okay, hypothetically, if U.S. Treasuries were to lose their risk-free status and begin trading with a credit spread, what would be the implications for UST as a global safe haven, and where would capital flow? when risk is off. So hypothetically, you're saying, okay, let's just jump past everything and let's just assume that it has a credit spread. Where would money go in if it's looking for a safe haven? It would probably go into T-bills, shorter term T-bills. There are countries whose longer term debt you may not want to buy, but whose T-bills you might feel comfortable with because, well, your risk is only for the next month or the next 3 months. So it would go into T-bills. The U.S. government would probably favor issuing more T-bills because the long end of the curve would really have higher yields. There's Japan. The Swiss franc has always been a safe haven in the European area, the Japanese yen in that particular area. And it could be that gold could be a safe haven, or even silver could be a safe haven. There'd be some that argue even the cryptos would be a place to go, but I doubt that institutional money of any significant size that's serious would do it. So it would still be the US dollar. It would still be US assets to a degree, probably favoring the 5-year down to the money market rates as opposed to the longer term debt. Since virtually all asset pricing models are based off the risk-free rate, would we start to add a risk premium, or would we need a new benchmark altogether, such as the Fed funds rate? Well, the Fed funds rate, no, you wouldn't use the Fed funds rate, I don't think, because it's not a market rate. You want a market reference rate, a SOFR, which is secured usually by T-bills. You could still use the U.S. as a risk-free, because you could always argue, look, I can always get the government rate. I can always get the government rate. So you'd probably still use it. I'd be interested in seeing a deep dive on what a world would look like if Treasuries lost their risk-free status, as I believe it would have a profound impact on finance and economics as we know it. It would, but if it did, financial engineering would create a new bond, would create a new risk-free bond. So imagine that the U.S. Treasury just wasn't suitable any longer. It wouldn't take long before an investment bank said, you know what we'll do? We'll take 10% of the Australian bond. We'll take 30% of the German bond. We'll take 20% of the Canadian bond, blah, blah, blah. And what we'll do is we'll wrap it up and issue a bond against this. And then we'll hedge out the currency in here. Or maybe, however they would want to do it. But they'll issue a bond against this, and they can create from all the other bonds a market just as big as U.S. Treasury. There'd be some financial engineering that comes in that creates a global bond like that. And perhaps have it all denominated in U.S. dollars, and work to hedge out whatever currency risk would be associated with that. I don't know. I'm just saying, at a very high abstract level, I think innovation in finance would step in to create something. If you're sort of getting me to lean towards Bitcoin, I will not. I don't think that is the solution in a safe haven. Bitcoin is a risk asset. It's up when risk is on. It's down when risk is off. That is precisely what you do not want. In a financial crisis, you don't want that asset dropping in value. Bitcoin has not demonstrated its ability to do anything but that. It is a risk-based asset. You want a risk-off asset, and that would be something that responds to changes in yields, which is fixed income. Why are service companies citing tariffs? Isn't it just the goods being tariffed? Service companies may use imported goods in the delivery of their service. So let's say you go to the hair salon, and all of that shampoo coming in now has a 10% or 15% tariff. So the cost of all of their products has gone up. The cost of the color they use in their hair, the cost of everything has gone up. There'll be some increase associated with that. So to the extent that it creates price pressure on the input materials that it uses, sure. Even the ISM Services Prices Paid Index have been moving up aggressively. Once AI starts cutting into jobs, do you think talks of universal basic income will start going up? I don't think so. Or is it more likely that people displaced are left to their own to reskill themselves? I don't see universal basic income being part of the landscape in a country like the US. To some extent, maybe the UK, maybe Canada, maybe France, to some extent. But I think it would be difficult to get that done. You can't raise taxes on individuals. You must raise taxes on corporations significantly. If corporate taxes are low and you are going to have a wealth transfer from the employee to the corporation, because if I adopt an AI tool, I don't need to hire someone. So if I start using AI and I can double my output, I've basically taken a salary away from somebody somewhere. Because let's say 100,000, I would have hired somebody for 100,000. But if I can use AI and produce that output that person would have done, I've just transferred the 100,000 from that person who would have got it to myself. So unless you raise tax rates on individuals and corporations who are using AI as opposed to hiring people, how are you going to get the money to pay what they would have earned? How are you going to get the money to give them a universal basic income? It's going to have to be something else. There will be job losses. I'd say, let's draw out a timeline. Here's what I think is going to happen is that you're going to have, as far as job losses, very few job losses at first, and then they're going to start. But while you're having very few job losses, here are job gains. Very few job gains as well, and they're going to start to drag down until they then start to build back up. Right? So you're going to have this kind of effect going on. This will be the transition period where all sorts of fear is going to come in about how bad this is going to be. And yes, I think that unemployment can get to about 10 to 15% without any dip in GDP. How can that be? GDP equals gross domestic income. So if you have 10 or 15% employment, you have that many people that are losing their job. How can you not have GDP shift? Because gross domestic income, what did I get here? Oh, good. Because gross domestic income also includes profits. And it will be a transfer from wages to profit. And the market in the short term will absorb that and will price that in as margins increasing, and will price that in. At some point, unless that profit is redistributed back into the economy to be spent, if you have AI producing all of this output, who's going to buy it? That's the big problem. But that's not going to be a problem until it becomes a problem. No one is going to solve that problem until it becomes a problem. That's the nature of politics, is that we can all see it's going to be a problem, but it will not be solved until it actually shows up. The market will not price it in until it actually shows up. In the meantime, this is going to be massively deflationary, and this is going to increase margins. I can see it. I mean, the speed at which this is progressing, and just the step function difference between last year's models and this year's models. Wow. And if you watched Google's I.O., their 2025, and what they presented, another wow. Understanding that a lot of these new models are coming out over the next few months. OpenAI's 5 series is going to be out in a couple of months. The Gemini 2.5 Pro already has 1 trillion parameters. And again, wow, I'm using it every day just to push it, just to see where I can get it to break so I can find out what is left for me. I'm not having much luck finding any ground to stand on. The one ground I can still stand on is this. Somebody has to evaluate the output. So when I get the output, I say, design a learning module for this, for at a high school level, at a university level, and at an industry professional level. And then I assess the output. Only then can I say, oh, okay, this needs to be changed, that needs to be changed. If I wasn't an expert in learning, I could never have noticed that. So what it does is it produces output much faster than I can. There's no need for me to develop the curriculum, no need to think about what pedagogical approach to take. I could just tell it what to do, but I still must evaluate the output. That's the last space left for me is an evaluation. This is going to be massively deflationary. It is going to be a wealth transfer from wages to profits. And what have we done in the US? We've lowered the tax rate on corporations. I don't see the forecasts of tax revenue working out at all. When you have growing incomes, but those incomes are distributed more towards profits which are taxed lower, you can't afford UBI. I have been going through the financial modeling course and Python course. I wonder how about writing code to make financial models. The idea is run the code. Oh, look at this. Now this is a perfect thing that you can run over to one of the LLMs. Gemini is a good one to do this. And within Gemini, you can get it to code. Right? Same with OpenAI, you can get it to code. And all you have to do is prompt it. You begin by prompting it, but yes, you can get that done. You can get this done. Although I will say this, it's not going to develop the basis upon which your forecast is made. Now, if you say, here is the most recent sales figure, I want you to model this growing at these rates over the next 5 years. It'll do that for you. You don't have to go in there and do it yourself. But once you have a spreadsheet, once your model's in the spreadsheet right now is faster and cheaper and better than any LLM when it comes to getting this done. Because if I need to calculate a ratio for 12 years, I only have to put into the spreadsheet equals this cell divided by this cell, and then I just drag it across those years. The spreadsheet already has within it the functionality of speed, of getting these things done fast. But you can do this. You can. Run the code. The code will ask for what kind of model you want to build with a series of questions. Based on that, creates an Excel, which is the template which you have to fill. Run the code again, which will build out the DCF model and some other important charts. Yeah, you can do that. It'll take a lot of time to develop the right prompting, but once you have the right prompting done, and once you run the code and you test it a few times, you get to the point where, okay, here we are. It might take you a couple of weeks, but then it's done, right? I did look up some of the website, but it doesn't have the kind of detail in the model that I want to try and implement. If it doesn't exist, it's probably because it isn't quite ready yet. I'll try to include as many nuances as possible that applies broadly. There's a trade-off between being detailed and having code template. Okay, well, I don't think we need to address that. When you're writing puts with the intent to be assigned the stock, do you take into account the open interest or the probability in the money when writing the put? If I want it, no, I just write the put. If I want it, I just write it. Probably in the money. What are your thoughts on embodied AI as in humanoid robots? Well, be physical AI, but I get it. Have you given any thoughts to investing in AI to gain exposure to this shift? It's all priced in. All the hype is priced in. I don't think... here's the thing. I'm not sure the producers of these AI models and the creators of these models are going to be the ones to capture the value. I think the users will capture more value because everyone's doing this. I don't need 10 LLMs. I only need one. And there is no one clear dominant winner. There's a leader right now, which is Gemini. There is one leader, but those things change. And when I ask Gemini something, I ask Perplexity something, I ask OpenAI something, I ask Manus something, I get answers that are all pretty good. Slightly different here and there, all pretty good, but in the end, Gemini more often than not has what I feel is a better answer. So I don't really know about investing in any one of these companies, even though Gemini is good and the new tools they're coming out with are good. They're not alone. There's lots of competition and more coming in. There are literally thousands of models out there, and more coming. And as the cost of compute goes down, and you may think, well, GPUs are still expensive, they're getting more powerful, which means the cost per instruction is dropping fairly quickly. As you have these big foundational models that you can then build domain-specific models on, the cost of development is going down. More and more companies are doing this. It's the Wild West. This is the .com where you have all of these models rushing in. Many of them will disappear. There'll be some winners 10 or 15 years in the future. I don't know who they are. But embodied AI, physical AI, in the form of a humanoid robot, based on where they are right now, they're still a long ways off. They're still a ways off. I don't know why it has to be humanoid. I don't know why it has to be humanoid. Okay, the world is designed for the human form. I get that. But it's a robot. With engineers, you can design a better form than a human form. You can design a better form. A humanoid robot right now still has trouble opening a door, because when it puts his hand on the door and it tries to open the door, part of it is pulling itself towards the door. So it then has to lean back a little bit to create the tension, to create that angle, so that when it opens the door, it doesn't pull itself forward, but it's pulling back the door. Opening a door is still a very difficult thing for a humanoid robot. Why does it have to be humanoid? I don't know. Anyways, give it 10 years. Give it 10 years. And yeah, I think you'll have something. I think your phone will be a better form of embodied AI long before a humanoid robot ever is. Your phone will have so much power. Download the Gemini app into your phone and watch what it can do. It's just incredible. And these models are coming out at a blistering speed. Inflation could prove to be very sticky in the short to medium term. I don't think so. We are at, the cusp, I think, of an incredible explosion in AI. What makes it, I think, at that point are the APIs. They're getting friendlier and friendlier to use. And that is the thing. The internet always existed. What really made it explode was Netscape, is the ability to navigate graphically and make it easy to use. The APIs are becoming easier and easier to use, to the point now where I don't use Google search. I won't use Google search. What's the point? I get better results out of Perplexity. Give Perplexity a try. Give it a try. Use that as your search tool. You will never go back to a static Google search with links. You'll never do that again. So I don't think we're going to be inflationary. All of this stuff is massively deflationary. Massively deflationary. I used to pay to have PDFs written for some of the videos I've done, and it would take 4 or 5 days to get done. I can feed my video to an LLM and I can get a good output in 8-9 minutes. Then I can put it into Google Docs and have Gemini fix it. It'll say it'll say, if you want suggestions or edit this or fix this or upgrade this, and I can have it upgraded. I can have it change the whole tone, make it more serious, make it less serious. I can pick whatever I want. I could say this is a learning module meant to teach, and it can then look at it and say this is a better organization. Then I could say I'm missing some content within this. Have a look at what I've done and make some decisions as to how to make it better. And it will. I don't need to pay anybody anything, and I can get that done over a period of like 2 hours. 2 hours, not 4 days, 2 hours. So the speed at which I can put things out there. Every year, we have to raise prices. Why? Because Amazon wants more. Google wants more, and we do use Google Mail. We have to pay for that. Google wants more. Every supplier wants more. Vimeo wants more. Everybody wants more every single year. Employees want more. Those pesky people say, look, I've worked last year, the whole year. Here's my salary. Where's my annual raise? Everybody wants more money every year. So prices have to go up, right? This is the first time where I'm looking at what I'm doing and I'm saying, you know what? I can actually reduce my prices and still increase my margin, still be more profitable per subscriber at a lower price. I've never been able to think that way. It's never been over the last 10 years or so, it's always been every year your costs are going up. Every year they're going to go up. Well, now they're going down. Now they're going down, and I could say, you know what, I could lower my price like 20% and still do better at 20% per subscriber than what I was before. This is going to be massively deflationary, and we're here. If you haven't been using these things lately, you have no idea what this can do. It's incredible. So I don't think that we're going to be sticky. I think the Fed is massively missing the boat on this one. A deflationary wave is coming, and they're sitting here looking at the goods sector and getting concerned about 10% tariffs on imports. On $3.2 trillion of imports, 10%, on a $30 trillion economy that is going to be hit by a wave of deflation. Missing the boat. Last few years of wage growth have been tied to the high inflation for 22-23. Hard to imagine wage deflation occurring anytime soon. Well, you don't necessarily need wage deflation. I think you're going to get wage inflation, but you're going to get higher levels of unemployment. You are very productive and you are an expert. I'll pay you 20% more. But these 4 people, I no longer need them because I'm paying you 20% more to get this done with AI. So it's actually cheaper for me. Right? And it's not wages, it's consumer demand that drives up the cost of things. And if the cost of things are going up, then people who have jobs say, I need to be paid more. And if they're being paid more, they get more, they go spend more, which drives the price up, thereby saying, oh, I need more again. But if you don't have aggregate demand, there you go. The longer the tariffs stay in effect, the more the businesses will have to cover to keep raising prices over and over again. No, they'll adjust. They will adjust. If you raise costs on me, I will find other ways around it. If I can't, I will raise my prices. But with AI right now, if you raise my costs, I can adjust. I can adapt. So no, I don't see this. I'm not with you on this one. I think the Fed is aware of these risks. Well, I think the Fed is focused only on these risks. And therefore does not give itself permission to cut because it's not looking at what's coming up behind it. Right? Check your back. Discord notification. Is there any way to get notified? Oh, this is a Discord. I don't know anything about this. I believe there is a way to get notified. When I post something, you can get notified when a single person does. I just don't know how to get that done. U.S. bonds become less desirable. Where would capital intended for the bond asset class flow to instead? Oh, I think they'd still flow to bonds, just other bonds. You mentioned now several times, and it's hard to imagine U.S. bonds becoming less desirable. You can imagine them becoming less of a value proposition, but in times of trouble, where are you going to go? Where are you going to go? They're not going to default. They haven't defaulted. to fix a problem, you must first make it a problem and highlight a problem. You're getting more people in Washington that are recognizing that the debt is a problem. If they do not see it as a problem, that's the big problem. They do see it as a problem. I just don't know if they have the execution ability to fix it. Oh, they'll say they got to fix it. They'll do this, they'll do that. But I don't think they know how. I think you're going to get terrible execution on this one. But in the end, where else are you going to go? And I do think the Fed is the answer to this one, not the fiscal. I do think that Powell will be gone. The new Fed chair will probably lower rates and increase the size of the balance sheet, and will have no choice. I think we're headed the way of Japan in this case, where the central bank holds most of the debt. Because you're going to need to flatten that curve almost to zero to overcome the deflationary wave that's coming. We are entering a world of surplus of everything, massive surplus of everything. So I don't see. I'm not too concerned about the debt. In fact, this morning I put out a bid for zero coupon principal strips. Maturing 2041, they were yielding 5.21. I'll take them. I'll start buying them. I have no problem. TLT was at threatened to break 83 today. And after thinking over the last week or so about where I think the state of affairs are, and after seeing the latest models that are coming out, that are hitting the market now, and what's about to come, I conclude that this is going to be massively deflationary, and bonds are probably, over the next 2 years, the best place to be. Where's TLT? 83.61 down 36 cents. Where is my bid? Let me just find my bid for the bonds here. I'll tell you where we are. I'm bidding 43.48 for these bonds, and the bid. The nearest bid is 43.56. I'm 43.48, which means if TLT revisits the lows of this morning, the low 83s, I'll be filled. And I'm buying 250,000 at a time. Well, when you say you're buying 250, you're buying 250 face value. Now multiply that by 0.4348 because I'm buying at 43.48 cents on the dollar. Multiply that by That's a little less than 125,000 each time, and I will continue to buy at those prices. I will continue to buy. So I'm not running away from it, and I don't think any significant fund in the U.S. that needs, like any pension fund, is going to say, oh no, 5.2%. We don't want that. That's a beautiful yield to get against their future obligations. You mentioned several times you think the Fed should cut, but I'd like to challenge that. I think the Fed actually needs to hike. Otherwise, the 30-year will skyrocket. 30-year is skyrocketing. But why do you think hiking would lower the 30-year? Right now, I don't think the long end of the curve is responding to inflation. I think this morning it's responding to the tax bill that was finally made it through. It does not go far enough. It will massively still increase the deficit and the debt unless revenue steps in to solve it. They haven't made enough cuts. So we have to rely on revenue, and only revenue, to get this done. And if you have a transfer of income from wages to the corporation and you're keeping tax rates on corporations low, it's not gonna happen. Not gonna happen. I think that's what's going on with the long end of the curve. So I don't think raising rates will fix that. In fact, if you raise rates, you actually make the situation worse, because you raise the interest expense the government has to pay, making the deficit and the debt even worse. You have to get those yields down. You got to get them down now. Cutting rates at this point will not help lower long maturity yields, as the market is concerned about inflation, especially when tariff effects are coming up. Managing longer-term rates isn't part of the Fed's dual mandate yet. They've done that. They have. They have done yield curve control. They have done that. Yields continue to rise, and they have. Trump blames Powell, and he will. And this time fires him or announces the next share, and he will. I think it's before July 4th. I think he'll try to fix the bond market by announcing a shadow Fed chair who will then say, look, I'll do all of this stuff. Market begins pricing corporate bonds from issuers like Toyota or Apple as safer than U.S. Treasuries. Toyota can issue 5-year at 1.5, 5-year Treasury 2. What happens with the risk-free rate? Yeah. Well, I guess the interbank rate would then become the new risk-free rate. Could Toyota begin pricing auto loans directly off its own bond curve? They do that. Car companies do that because they do have a lower cost of capital. So they can be more competitive on financing rates than a bank can. However, they still have to attract capital to their bonds when they issue bonds. So even though they could offer a lower rate, that's if they held it on their own balance sheet. If they care to place it in the market through other bonds, asset-backed bonds or car loan-backed bonds, you still have to be competitive in the bond market. So, but they do have a lower cost of capital, sure. If companies and individuals are willing to pay up to $200 a month now, then wouldn't the creator of LLMs and reasoning models charge like $500, even $1,000 a month to cover the depreciation and generate profit? For enterprise customers, oh yes, that number is big for enterprise customers. And Google, I think, reported they have like 7 million developers around the world using their tools. So I don't know that they're making any money yet because of the sheer size of the investments they're making, because they're building up their capacity while they're selling it at the same time. You have to get to a point where you're as big as you're going to get, you're as stable as you're going to be, and you have new customers coming on, and your costs are being driven down. I think that's going to be a while before they get there. To pay $249 a month, you can do that. That's $3,000 a year, but that's only available in the U.S. You really need to be a production house of some sort. Most of the tools that are in there that you're paying for, you're doing some significant stuff. You're not just in your house. Anybody in their house, I see no reason that they would need more than $20, unless you're a business. Then I could see you going to the $200 or even the $250 a month, but you are using it a lot. In which case, it's still very expensive to do every search. It's still really expensive. So everyone's fighting for eyeballs right now. Everybody's fighting for customers. Everybody's fighting for market share, because all these models they're in around the same area. Some are, when you benchmark them, some are coming out better here and better there, but they're all in the same neighborhood, and they'll all get better. There will be a lot of shakeout at some point. A lot of these companies are going to go away. Which ones? I don't know. But a lot of them are going to go away. You're not going to need 7 or 8 big foundational models. Some of them aren't going to be profitable. I think it'll end up sort of like an oligopoly, sort of like iOS versus Android. There'll be 2 or 3 big models that are embedded in different devices, embedded in different browsers, and with different interfaces. And it's kind of like, well, you can get your phone from AT&T, from Verizon, or T-Mobile, and I think that's what it'll probably end up being. I've noticed a correlation. I was hoping to get your insight on it. Why are Canadian yields seemingly highly correlated with American ones? I fail to rationalize it, especially considering the growing divergence between American and Canadian financial system, economy, inflation, and fiscal monetary policy. Yeah, there is the correlation. So if you think that bond yields are priced off the U.S. Treasury curve with some country risk premium, then you could see that all countries would be related to the U.S. to some degree through their country risk premium, I think. But I don't know that the Canadian and U.S. economies are disintegrated enough, not disintegrate, but disintegrated or unintegrated enough that they could go their own direction. Time of this post, ABR is trading under 9. Do you think it's a good entry level? No, I do not. I said this before about ABR. Be careful about ABR. Everything changed when they shut down the border. Most of the loans that they have out are for properties that are being repositioned in these southern states. They rely a lot. Those buildings will rely a lot on the level of immigration in that area to get their tenants, because that's the marketplace for the buildings they're repositioning. So if you're not getting your occupancy rates, that's a problem. The other big problem is they can't get these loans off their books and into the GSE at 10-year yields above 4.5%. They've said this before, that under 4% they can get a lot done, but over 4%, over 4.5, that's a problem. So right now you have two bad things going on. You have yields which are not helping ABR, and you have a drop in immigration in the southern states, which is not helping the building owners of the buildings they have loans out against. So I wouldn't touch ABR at these points. IBKR notes that it is among the most shorted stock they have. Its short cost is like 5.5%. I looked at it this morning. For long-term buy and hold, looks good to me. Looks like it's around 20% discount to book value, if you can believe that book value. Some discount is fair considering delinquencies, current short reports, recent dividend cut, potential for book value drop if yields stay high, but forward dividend yield 14% out of the cut is attractive and not sustainable. Short interest is high. Yes, U.S. government agenda for lower yields make for quite a lucrative income play and potentially decent capital appreciation. That's the play. And I would say that was the only play. It is a really I think risky duration bet. Is you got to hope for that 10-year yield to drop considerably. I don't see it in the short term, and you can go through a lot of pain before you get there. Keep in mind, ABR has to continually refinance itself. What if its financing dries up? That's what happened in the great financial crisis. Is its financing dried up? It dropped to under $1, and it was 3 or 4 years before it came back up. It still, to this day, has never reclaimed the high 20s, low 30s it had in 2006, 2007. Never got back to those levels. It was a friend of mine for a very long time. It paid well, and I made a lot of money off this. But the environment that it's in right now, the drop in it, if it wasn't for the shutting the border, if you didn't shut the border and you still had that coming in, I would say this looks like a good opportunity. But you have a drop in the potential tenants, significant drop in the potential tenants for their clients, along with a funding cost that doesn't allow you to move those loans off your books to the GSE, and high short-term funding costs. There is nothing attractive about this environment. Now, they have good management. They'll see their way through this, but I don't know that you're going to see $12 before you see $5. I think if I had to bet on this, I think you'd see $5 before $12. Right? So I'd be careful with this one. Okay, let's do some YouTube comments. What happened to shorting with impunity? Still short. I am still short. Could be an ugly week for duration. Does anyone remember the duration of a really good week? Yeah. You believe Trump will soon appoint a new Fed chair that will lower rates and maybe even engage in yield curve control? Why do you switch your TLT position at Treasuries? Wouldn't TLT be a more convex play? No. If you expect a long end of the curve to drop in the future? No. A zero coupon would have the highest convexity. That would be a more convex play. That would be a better play. Quickly flipped into some highly confident and consequential opinions on AI. Yes, as the facts change, I'll change my mind. A year ago, I was Now I'm, oh my God. And based on projections of what's coming, it's unbelievable. Last week's Q&A said something like, you think your skills will be mostly obsolete by 2030. True. I do think they will. I think they'll be mostly obsolete by this time next year. How strongly do you really believe this? 100%. I am working a lot with all the different AI tools to try to figure out what's left for me, right? I do believe, now I will adapt. I'll figure it out. I'll find some place for me. But I think if you look at the distribution that's out there, I think a lot are going to disappear. Given your broad expertise in trends and predictions, it'd be interesting to know how convinced you are. Fairly convinced. Fairly convinced that a lot of the stuff I do will be, it would be no longer necessary for me to do those things, which means I have to move to more of a meta job as opposed to the actual things that I do. Higher tariffs are rather probably, but new Fed chair, that's bold and scary. I think you'll get an announcement. I think you will. AI is likely to get to a singularity state where AI works on itself and is able to self-create and provide answers to questions we haven't even considered yet. It's already there. Already there. That may be when a single AI rules supreme like an app store. I don't know. Would it be possible the Fed is maintaining and will maintain restrictive rates so they are in a favorable position to QE and take down the long end of the curve while with the government having to roll over debt in the near future? I don't know. I mean, I think if you talk to 15 people about what the Fed is doing, you'll get 15 theories about what they could be doing. Injecting that amount of money in the economy would spike inflation. But keeping rates restrictive would help mitigate that spike in my mind. See, I don't think inflation is the enemy. Technology is deflationary, and technology is accelerating. I've been saying that for the last year and a half, 2 years, that inflation really isn't going to be the problem going forward. It's deflation that's going to be the problem. And I think that's going to show up sooner than later. Negative points in making a change in yields no, I don't think I made a mistake there. No. Also, I would like to ask, what if TLT made of that you? Also, I would like to ask, what is the TLT made of that you would allow yourself to add it to 20, 30-year duration? That's exactly what it's made of. It's made of 20 and 30-year bonds. And I'm not putting 20 or 30-year duration in there. It doesn't have a duration statistic that high. It has an average maturity between 20 and 30 years, but its duration statistic is under 16. Is there a link for Discord? Okay, I'm not gonna. I think we've taken care of those. V-shaped recoveries we've seen in the last decade and a half. Remember that muscle memory. It seems reasonable to me that faster access to information, trading 24/7 in your pocket, and automation has changed the game. I think you're right on that. We have to think, there's a whole generation, because for the last 15, 16 years, it's V-shaped recoveries. We have a whole generation that has been programmed to buy the dip. You always buy the dip. We have more passive money out there. We have active money that has no choice but to perform, which means whenever there's a 1 or 2 or 3% pullback, it's a good opportunity to put money to work because you got to beat the index, and they're betting on that V-shaped recovery. And you have a bunch of trading platforms out there that have turned the market into a giant big casino. So it could be that valuation matters less and less because it's more about playing the game than it is about analyzing and buying value where value is. It's about buying price where price is. Yeah, could be. Will the applied analysis video be on YouTube? Nope. Unable to find the link. Anyone know? Kept up. I'm still in TLT. Yes, I am. I asked AI, it said you don't need master economics to master finances. Okay, you keep asking me the same question every week. I'm going to ignore it now. Could this Moody's downgrade be the catalyst for the admin to shift all their focus along on the curve? It could be. Or it could be a reason to ignore it or brush it off, like they did. So Besant made the tour this weekend. Oh, we don't care about Moody's. It's a trailing indicator. It's backwards looking, this and that. And they just, if they repeat it enough times, they get to the conclusion that, oh, we don't need to pay attention to it. It's meaningless to begin with. So I think no. In the grand scheme of things, I think they will convince themselves that it's meaningless. And if it is something, they'll blame it on the last administration. Actually, they did. Besant did do that. He did blame it on the Biden administration. It was what Biden did. It's backwards looking. We sort of knew this. They're late to the game. Yeah, no. It's just gonna, no, not do anything. If you're right about a new Fed, then wouldn't that be a right time to buy TLT? Well, it's a question of how low can it go first, right? I know you're very far from the job, but I want a general opinion since you have lived your life through many transition phases like the internet. Who do you see are the people who succeed in these type phases, and what types of jobs are safe from a transition like AI? Well, experts who know how to use AI. You still need experts. How will you know that a certain job will not be affected by the change or gets a little bit affected? If the job can be mostly automated. If you can say, look, everything you do, I can ask AI and get the same output, that job is no longer needed. I can't go from job to job and task to task on that one. It's just, if you have self-driving trucks, do you need truck drivers anymore? I mean, you could just make that. You can just look at any job and say, well, does AI do that job now? Can I ask AI to do that and get an output in 5 minutes? Do I need to wait 3 hours for the employee to do it? If the answer is yeah, I can get AI to do it, then you don't need the employee. Our answers to all these above questions will be different for different transitions. Generally speaking, yes. I don't know enough. There's not enough information in there for me to even begin to answer that question, really. Yeah, this is a seminar about technological transitions and the effect on labor markets. That I could talk for 4 hours on that. Of how it affected the distance, in the speed of communication, the distance between points. Most technologies have been enabling, meaning that you have the technology, but unless you have humans, it's not going to work. So it really was about the labor to capital ratio. AI is not about the labor to capital ratio in many cases. It's about capital completely eliminating the need for labor. That's a different transition that we have right now. I mean, when field hands worked the field and you gave them a tractor, someone still had to drive the tractor. That allowed you to do more in a day. It allowed you to do more land in a day, or more land for the farm overall. So the size of the farms got bigger. It made humans more productive. This is a technology that has the very real potential to eliminate about 33% of all work that you don't need a human for, right? So it is different. So will non-cognitive, non-routine cognitive work is also going to get replaced. The work will get replaced. As I said before, you still need somebody to produce the inputs and to evaluate the outputs. Can you give examples of what you consider as non-cognitive, non-routine cognitive work? Marketing strategy. Develop a marketing strategy. Here's a description of my core customer. Here's an example of the marketing material I have. Here are the level of sales I generate. Evaluate and make recommendations. There you Is it 3.2 trillion of imports, including inputs to goods and services, or just 3.2 trillion of imports direct to the consumer? It's three. Well, you can't import when you import a service. It's you can't see it. These are goods that are crossing a border, so it's goods. 3.2 trillion, and a percentage of that 3.2. I shouldn't say you can't tax a service. I mean, you can. Trump is threatening to put tariffs on any movie that is not produced in the U.S., which is stupid. But there it is. Free access in the website. Okay. So recent market outlook where you talked about AI was horrifying. As I'm at the stage, I'm 25 years old, recently graduated. Was the solution then? Get yourself in the right tail of the distribution of knowledge. You should go to the end of the distribution as fast as possible. How to make that possible? Keep doing what you're doing. You got education, keep going. Never stop learning. By saying get on board now, what do you mean by it? It means use it, learn it. I'm already using all of that. What else to do? There you go. Just keep going. Keep up with it. It is going to move fast. The tools and new applications are going to come out faster than you can keep up with it. You said to get to the expert levels. So what the, okay, these are just repeat questions. No, come on. I mean, if you want me to answer a question, don't write a book. No. I have a question about the applied level. What is the amount of investable assets you would consider the minimum for retail investors to have to get started with the techniques you teach? $1,000 at the buy and hold. All right, I can't answer that question because I know nothing about you. I know nothing about your ability or your skill. I know nothing about what strategies you plan to follow. I have no idea. That's a tough one to answer. Not until I actually have a conversation with you. How much have you got? What kind of job have you got? What is your income potential? I mean, if you say, I got $5,000 and I don't have a job, then don't do a damn thing with it. You're going to need it. So there is no generic answer to a question like that. What do you make of the speculation that tariffs are bound to stay around 10% because tariffs are a revenue strategy? Rather than onshoring. You mean if they try to push it higher, they'll get some onshoring? But if you have onshoring, you are producing GDP, and you tax GDP at 17%, 18%. That's a revenue strategy, right? So I can tax your product coming across the border at 10%, or if you make it here and you add to GDP, whatever income you have, I tax at 17%, right? There is more to be made by taxing GDP than by taxing tariffs, so I think they're going higher. If anyone can move a mine to another country, it's Elon. Accounting. I saw in your AI for finance intro video, you said you could see a sizable portion of accountants becoming redundant in the near future. I do believe that, yeah. With legal implications and accountability necessary for tax filing and independent auditing, I'm curious to see why you don't see accounting moving into the second bucket. I will focus on developing my AI skills, but do you see a way to delay the inevitable? Not really. You can give all the documentation, the whole tax code, and the whole accounting standards to a model as input, along with all of your transactions. And it will, if you have the form for your taxes as well, give it that, it will do it for you. So a lot of small businesses probably won't know how to do it, so they'll still have accountants. But medium-sized businesses that have the skill within the organization, they'll start using it. The CFO will start using it within that department, and they will be able to reduce the number of people they have. An auditing firm will figure out very quickly that it can use this. Because when you put documents, and when you use an LLM on documents, you're not giving the documents to the LLM. Let's be clear about that. All you're doing is using a tool to do a better search, to do a better analysis. That's all you're doing. It's the same as using a calculator. The accounting firm wouldn't say, hey, auditors, don't use a calculator. We don't want to input all of the company's financials into the calculator. That would be a stupid statement. It's the same thing for LLMs. It would be a stupid statement. No, I think accounting is probably more under threat than finance, because if we're thinking about what would be more rules-based, it would be accounting. Wouldn't it be the bond and not the stock market that would embolden Trump to get away with escalating the tariff war? If you're going to ask me a question of which you already have a predisposition to what the answer is, you must also include your logic. Why? Why would it be the bond market? You're asking me to come up with your reasons why. I don't know. I'm going to say no, because you haven't given me any argument. Debt is such a big issue. Doesn't mean tariffs, Doge, and closing on federal agencies were the right move to bring down federal costs and deficits. All of these were good strategies. The execution was terrible. It's the execution that was bad. Now, if I said, I think I want to start dating, because I'm single, I've been alone for a long time, and maybe it's time. I have time in my life, so maybe it's time. And most people say, okay, well, that's good, a good strategy. So I go out there and I stop women on the street and say, you want to go home and have sex with me? No? You want to go home and have sex? You would say, whoa, what are you doing? And I said, I'm doing exactly what I said I told you I would do, going out and finding someone. You would say, dude, that's some real bad execution. Well, that's what we have over here, is just really bad execution. Yeah, the policies were right, but the execution is terrible. However, I don't think this is a group of people with a high level of execution intelligence. Of course, the tax cuts doesn't help, as that would negate all the benefits of the other things. That's true. Regarding Powell, regardless of the messaging, if Fed is supposed to be neutral to politics, he should have cut. I think he should have. I agree he needed to cut, and even more so now. He shouldn't care about the optics, but about the yield curve and the problems the U.S. faces with higher rates. Well, unfortunately, the market would have seen it as the Fed bending to Trump's will. Had Trump said nothing, when we don't have a counterfactual, all we can do is sort of suspect. If Trump had said nothing, I suspect that you probably, I shouldn't say probably would have, a much higher probability of a rate cut, and maybe even permission to cut, or at the very least an SEP that will show maybe more than 2 cuts for the rest of this year. Right? Why do you assume that bond yields should just give the inflation? Why do you assume that bond yields should just give the inflation returns? Let's say you have $1 million and know that inflation will be 2% for the next 20 years. Would you invest that million for a 4% yield? I certainly would not. Well, there is a reason why you're taking a bond. You're not necessarily taking it for the 2% real yield. By the way, a 2% real yield is a fairly decent yield. If you're preserving the purchasing power of your assets and you're getting a basically, as we describe treasuries today, risk-free asset that will give you a 2% real return, that's pretty good. The reason you're holding the bond is because it's a great hedge against bad outcomes, right? If you have nothing but high beta risky stocks and the market turns down, you're going to hurt badly. You're going to want something in your portfolio that zigs when all of that zags. Well, that's what this does. It preserves the purchasing power of your assets, provides you with a real return, and it's a beautiful insurance policy when shit hits the fan. It just has not acted that way lately, but it typically does. I think what we need is more shit to hit the bigger fan. And if that happens, you'll be thankful for having these. I also think that the chance of inflation going higher sometime in the next 20 years is pretty high, and these yields are not compensating for that risk. I think we should normalize 5% rates. I don't think so. I disagree with you there. I think the fear of deflation is not real enough. I think after a couple of years of 1%, 2% deflation, things are going to get very strategic at central banks. the yields around the world, I think, are going to drop very fast. And there we go. I'm sorry about the long one, but really, it's a book. So I'm just not going to read a book. That's it.